Hey guys, welcome back. Today we talk FICO. Is Fair Isaac maybe the best AI play with the ultimate data moat? We will find out in a second, guys. Let me tell you this before we go through use case, profitability, growth, defendability, risks, my investment thesis, and the current valuation, that FICO is one of my favorite business models on the planet. And that for 5 full years, I wanted to own FICO. I just didn't buy it because there was no margin of safety in the price. But then something happened. So it was on my watch list all the time. And then something happened. And there was a dip. Let's go, guys. Let's go into FICO. First of all, use case. Who is it for? What is it for? One of the clients of FICO is a mortgage institute called Rocket Mortgage. They used FICO score to become America's largest digital lender. And one of the ways they did it is they used the FICO score to process 264,000 home purchases in a year. They leveraged the FICO score to deliver loan approvals for houses. So you want a house, they say, I approve or I don't approve your loan. Took them 2 hours. If you are in finance, you know that industry average is 35 days, 30 to 45 days. And they did it in 2 hours without any human underwriters. So it's a full automated credit decisions that people can do because they trust the FICO score. Why do they trust the FICO score? It's been around so long and it is precise. Also, you don't get fired for using FICO. It's one of these things like IBM or McKinsey where there is a period in time, and we are in this period. If you decide to use other scores, you might get criticized and fired if it goes wrong. But if you pick the FICO score, you've picked the gold standard, and it won't have negative repercussions on your career. ROI results for Rocket Mortgage, 2-hour approval times versus 30 plus days. 193,000 purchased loans closed faster, easier. 73% application to closing basically automated without any lengthy manual reviews. If there were manual reviews, they were just checking the last 3% of something that was prepared. So that's the use case. It is for lenders to take the best decisions, basically the brain of the lenders. And my boss in St. Gallen in Switzerland taught me something very, very important. He said, Simon, capitalism is not a game about maximizing profits. It is a game about staying in the game. It is based on lending, and it's like Monopoly. You come back for multiple rounds, then you win. But it's a game of lending. The whole capitalist society is based on debt that's used for growth. So families take debt to buy a house. Companies take debt to be in the business cycle and stay in the business cycle. That's around 4 or 5 years. These things are ingrained in our society. So for me, FICO is cyclical because it fits with the business cycle, 4 or 5 years. But it's also a secular trend because if I ask myself, will lending be a central thing in the US in 10 years? The answer is yes. And so FICO might have a core role also in 10 years, like it's having it right now. Is it profitable? It is extremely profitable. That's why I did fall in love with this company 5 years ago. It has a 42% ROIC, which is incredible. And it's slowly declining, but even if it declines to 35, 30, 25, 20 even, that's still one of the top 10 companies for me on the planet. So we have been buying FICO at the right time when the price was dipping because they were under attack. Now, if you're alone as an investor, you need somebody to discuss this with. Hey guys, there is this company, I really like it. There is a dip. Is this dip temporary or not? Should I buy? Should I hold? Should I sell? What should I do? These discussions happen in the Sprint Club. We are connected 24/7. I have this on my phone. And we discuss this 24/7. I'm sharing the real-time trades, and I share the exact hour, not even the day, the exact hour I bought into FICO. So join us. It's free. You can hang out for 7 days before you invest anything. Now, growth is 15%, which is exactly where we want it to be. We want it to be above 15% in a way that is sustainable. And because it's 15, it is sustainable. If it was 25, I wasn't sure about the sustainability, but it's 15. FICO can grow at 15 because of all the moats that you will see in a second. We don't have network effects, but we have loyalty because banks, those major banks, Wells Fargo and the lenders also, they literally cannot afford the operational, regulatory, reputational risk of moving away from the gold standard in this industry that regulators expect and accept. That's this IBM dynamic that I was describing. That creates loyal customers because nobody wants to take on so much risk to change anything. And it is a conservative industry. As you know, if you work in finance, risk management is the number one thing. And so this plays in the cards of FICO. IP, yes, there is proprietary credit scoring. There are algorithms. There is 70 years of predictive modeling expertise in there. That's a moat. And while we don't have network effects, there are two bonus moats with FICO. One is the regulatory one. They're embedded in banking regulation, Dodd-Frank, GSE requirements. And then there is brand risk aversion where, no fund manager, no VP of no director of a lending company, no managing director of a major bank wants to be the person who took that decision that went wrong. So they go for nobody gets fired for buying FICO mentality. This is the look at moats. So no network effects, but loyalty and IP plus regulation and brand risk aversion. Then SWOT analysis shows us that this company is the ultimate switching cost moat with 90% of the market in the US credit scoring market. So it's 90% market share in the US, in the scoring market. There is regulatory entrenchment and 1.4 billion revenue from essential financial infrastructure. Then we have weaknesses. Well, we are dependent on US lending cycles. That's the 4 to 5 year business cycle where companies take on credit and renew it after 4 or 5 years. So there is some cyclicality that we don't like, actually, but in this case, it's okay. And there is regulatory vulnerability, and there is limited diversification beyond core credit scoring products, even if they're working on it, different intelligence and AI solutions. Then threats, of course, AI disruption, and opportunities, international expansion, AI-enhanced scoring models, alternative data integration, adjacent financial analytics products. You can imagine a whole plethora of products that you can put on that. If people trust you already, and if you're working with the lenders, then you can ask, what else in terms of financial problems, financial data problems do you have right now? How can I solve them for you? What else in terms of lending decisions do you have to solve? How can I help you and create additional adjacent products on that, which they are doing because they're smart people. My investment thesis for FICO is they are the ultimate switching costs. Lenders are locked into FICO scores by regulation, by habit, and by risk aversion. It is leading the $4 trillion US lending market. So my former mentor and boss in St. Gallen was right. The lending market is a foundational market with 4 trillion right now and growing. This is a huge total addressable market. That's the basis of the US society, because the society is built on debt in this case. Now to valuation. Is it a buy right now? I think, according to our DCF, the fair value June 2025 is 1,600. So current price is 1,816. There is no margin of safety if you buy it now. Still a high quality company, but you have to wait much longer to generate plus 15 CAGR. And there was the opportunity to buy, and people who were in the Sprint Club, they took chance at that opportunity because we were discussing and analyzing live, and we could act on that opportunity. So make sure you have a trusted set of partners on your phone that are 24/7 supportive and available to you to discuss these things, where you can improve processes. And by the way, we made quite some money by solving marketing and sales problems. Now we're learning how to keep that money in compounding portfolio, but the compounding portfolio gives you cash flow in 20 years. So we have added the income portfolio, and the income portfolio is generating cash flow right now, month by month, with a small account of 150K. Last month, I generated $8,900 in income, and this month it's $8,900 in income, and last month $14,000 in income from a 150K portfolio. So it's almost 10% that we can generate. So let's assume 5% that we can generate per month. That's what the income portfolio can do for you. If you want me as a mentor and if you want to access the community, join us at strategysprints.com. Let's build that month by month cash flow with you. Keep rolling, everyone. See you on the other side.